Chapter 14, Accounts Payable and Other Liabilities. The term accounts payable is used to describe short-term obligations arising from the purchase of goods and services in the ordinary course of business. Typical transactions creating accounts payable include the acquisition on credit of merchandise, raw materials, plant assets, and office supplies. Other sources of accounts payable include the receipt of services such as legal and accounting services. Invoices and statements from suppliers usually support accounts payable arising from the purchase of goods or services and most other liabilities. However, interest-bearing receivables are not included in accounts payable. They would be included in bonds, notes, etc. Accrued liabilities generally accumulate over time, and management must make accounting estimates of the year-end liability. Such estimates are often necessary for salaries, pensions, interest, rent, taxes, and other similar items. If the estimates are not made, then no entry will occur since the related transactions may have occurred months ago. These are the objectives for the audit of accounts payable and purchases. After using their understanding of the client and its environment to consider inherent risk, including fraud risk related to accounts payable and the internal controls over accounts payable, the auditor will assess the risk of material misstatement and design tests of controls and substantive procedures, such as those shown in this slide and discussed later in the presentation. In the audit of liabilities, the auditors are primarily concerned with the possibility of understatement or omission of liabilities. An understatement of liabilities will exaggerate the financial strength of a company and conceal fraud just as effectively as an overstatement of assets. Furthermore, the understatement of liabilities is usually accompanied by the understatement of expenses and an overstatement of net income. In considering the internal controls over accounts payable, it is important to recognize that the payables of one company are the receivables of another. The self-interest of the creditors constitutes somewhat an effective control of payables that is not present in the case of accounts receivable. Also, the discussion of internal control applicable to accounts payable may logically be extended to the entire purchase or acquisition cycle, which we have discussed in the course previously. This slide lists internal controls that the auditor would expect to find in most accounts payable systems. This slide shows a flow chart of documents in the purchase system, starting with the stores department's preparation of a purchase requisition and the purchasing department's receipt of the purchase requisition and preparation of a purchase order. When the goods are received, the receiving department prepares the receiving report. Copies of the purchase order and receiving reports are forwarded to accounts payable, where they are matched to the vendor invoice for verification prior to the entry in the voucher payment system. This slide lists some of the potential misstatements in accounts payable, along with examples of frauds and errors that can occur, and the internal control weaknesses or factors that increase the risk of the misstatement. A common fraud that can occur in smaller companies is when a bookkeeper prepares a check to himself and records it as having been issued to a supplier. Inadequate segregation of duties of record keeping and preparing cash disbursements, or a check signer that does not review and cancel supporting documents, can allow this type of fraud to occur. Misappropriation of purchases can occur when goods are ordered but delivered to an inappropriate address and stolen. The weakness that allows this type of fraud is when there's ineffective controls for matching invoices with receiving documents before disbursements are authorized. Last, cutoff issues resulting in late recording of purchases can be accomplished by closing the purchase journal early and subsequently recording purchases in the next period. This fraud is associated with ineffective controls in the control environment. An assessment of low control risk for accounts payable often means that the auditors have found that serially numbered receiving reports are prepared promptly by the client for all goods received, that serially numbered vouchers are prepared and recorded in the voucher register, and that payments are made promptly on the due dates and immediately recorded in the cash payments journal and accounts payable subsidiary ledger. Finally, at the end of the month, the employee who does not participate in processing accounts payable compares the individual accounts in the accounts payable subsidiary ledger with vendor statements, and also compares the total of the subsidiary record with the general ledger control account. This strong internal control would enable the auditors to minimize substantive procedures for accounts payable. On the other hand, an assessment of high control risk for accounts payable often means that the auditors have found that the subsidiary record of accounts payable is not in agreement with the general ledger control account, that receiving reports and vouchers are used haphazardly, that purchase transactions often are not recorded until payment is made, and that many accounts payable are long past due. In this situation, the auditor should undertake extensive substantive work if they are to determine that the balance sheet amount for accounts payable includes all liabilities in existence at the balance sheet date. The auditor will now perform tests of controls. These tests include verifying a sample of postings to the accounts payable control account, at the same time scrutinizing all entries to the control account for the entire period under audit for any unusual entries needing further investigation. The auditor will vouch to supporting documents a sample of postings in selected accounts of the accounts payable subsidiary ledger. The auditors may also perform tests by following the audit trail in the opposite direction. By tracing a sample of entries from the source documents to the accounts payable ledger, the auditor can verify completeness, accuracy, and timeliness of recording of accounts payable. When the client has established effective IT application controls for purchase transactions, the auditors may find it more efficient to test these controls rather than to test a sample of purchase transactions. If necessary, the auditor will revise the risk of material misstatement based on the results of test of controls. The auditor will next perform substantive procedures for accounts payable. The auditor will obtain or prepare a trial balance of accounts payable as of the balance sheet date and reconcile to the general ledger. The vouching of selected creditors' balances to supporting vouchers, invoices, purchase orders, and receiving reports is to provide evidence of the existence and valuation of accounts payable, and the auditor may also reconcile accounts to vendor statements. The auditors may confirm accounts payable by direct correspondence with vendors. This step is not widely used, though, because of the availability of externally generated evidence, such as vendors' invoices and statements. To gain assurance as to the overall reasonableness of accounts payable, the auditor may compute ratios such as purchases divided by accounts payable and accounts payable divided by total current liabilities. Throughout the audit, the auditors should be alert for any unrecorded payables, including normal trade payables, unrecorded liabilities related to customers' deposits, obligations for securities purchased but not settled at the balance sheet date, etc. A search for unrecorded liabilities will also include reviewing transactions recorded following year-end. The auditors will perform procedures to identify accounts payable to related parties, such as the corporation's officers, directors, stockholders, or affiliates, since they are not the result of arm's-length bargaining by parties of opposing interest. Last, the auditor will evaluate proper balance sheet presentation and disclosure of accounts payable. This slide lists the objectives or management assertions for the major substantive procedures for accounts payable. This slide contrasts the confirmation of accounts payable and accounts receivable. The primary audit objectives of the two procedures are different. When confirming accounts payable, the auditor's objective is completeness, not existence. For this reason, the confirmation process for payables is more effective if the auditors use a blank form of confirmation, requesting that the vendor fill in the amount of the liability rather than to confirm a recorded amount. Using this method, the auditor is more likely to find unrecorded liabilities. Also, since there is greater external evidence available to confirm balances already recorded, the auditor may be more likely to send confirmations to vendors who have a zero balance, vendors who do not provide monthly statements, accounts reflecting unusual transactions, accounts with a parent or subsidiary corporation, or accounts secured by pledged assets. During the auditing procedures of reconciliation, confirmation, and analytical procedures, the auditors were also searching for unrecorded accounts payable. However, a comparison of cash payments occurring after the balance sheet date with the accounts payable trial balance is generally the most effective means of disclosing unrecorded accounts payable. All liabilities must eventually be paid and will therefore be reflected in the accounts at least by the time they are paid. Regular monthly expenses such as rent and utilities are often posted to the ledger accounts directly from the cash disbursement journal without any account payable or other liability having been set up. Therefore, the auditor will often examine all cash disbursements over specific dollar amounts that are made by the client during the subsequent period. The auditor should also consider potential sources of unrecorded payables such as unmatched invoices and unbilled receiving reports. These are called work in process in a voucher system, and the auditor should review them to determine if the client has recorded an accounts payable when appropriate. Vouchers payable entered in the voucher register subsequent to the balance sheet date should be inspected to uncover any items that should have been recorded as of the balance sheet date. Invoices received by the client after the balance sheet date should be reviewed because not all vendors send invoices promptly when goods are shipped or services are rendered. Consignments in which the client acts as a consignee may need liabilities recorded for goods sold to third parties shortly before year end. This slide shows an audit work paper used to summarize unrecorded accounts payable discovered by the auditors. Dates, invoice numbers, vendor names, and descriptions, as well as the accounts charged and the amount should be listed. The auditor will review the unrecorded liabilities to determine whether the omission are sufficiently material to warrant proposing an adjusting entry and initial and date the work paper. When the auditor is considering whether to make an adjusting entry for omissions and misstatements, the first decision will be to determine if the adjusting entry would add equal amounts to current assets and current liabilities. If so, the omission does not affect the current ratio except slightly, and the auditor would probably consider the transaction as not sufficiently material to warrant adjustment. If the omission affected only current liabilities, then the auditor would be more likely to adjust the records because the current ratio would be overstated. If net income is affected, then the auditor would also be more likely to adjust for the misstatement or omission. When determining materiality, the auditor needs to consider the post-tax effect and also the cumulative effect on the financial statements of all unrecorded or past entries. In addition to the accounts payables previously considered, other items classified as current liabilities include income taxes withheld from employees' pay but not remitted as of the balance sheet date. The auditors will verify the liability recorded by tracing the amounts withheld to the payroll summary sheets, testing computations of taxes withheld and accrued, determining that taxes have been deposited or paid in accordance with federal and state laws and regulations, and reviewing quarterly tax returns. In most sections of the United States, business concerns involved in retail sales are required to collect sales taxes imposed by state and local governments. These taxes do not represent an expense to the business. The retailer merely acts as a collecting agent. Until the amounts collected from customers are remitted to the taxing authority, they constitute current liabilities of the business. The auditor's verification of this liability includes a review of the client's periodic tax returns. The reasonableness of the liability is tested by a computation applying the tax rate to total taxable sales. In addition, the auditor should examine a number of sales invoices to ascertain that customers are being charged the correct amount of tax. Debits to the liability account for remittance to the taxing authority should be traced to copies of the tax returns and vouched to the paid checks. Unclaimed wages are, by their very nature, subject to misappropriation. The auditors, therefore, are concerned with the adequacy of internal control over this item. A list of unpaid wages should be prepared after each payroll distribution. The payroll check should not be left for more than a few days in the payroll department. Prompt deposit in a special bank account provides much improved control. The auditors will analyze the unclaimed wages account for the purpose of determining that the credits represent all unclaimed wages after each payroll distribution and the debits represent only authorized payments to employees, remittances to the state under unclaimed property laws, or transfers back to general cash funds through approved procedures. Many companies require that customers make deposits on returnable containers. Public utilities and common carriers also may require deposits to guarantee payment of bills or to cover equipment on loan to the customer. A review of the procedures followed in accepting and returning deposits should be made by the auditors with a view to disclosing any shortcomings in internal controls. The verification should include obtaining a list of the individual deposits and a comparison of the total with the general ledger control account. If deposits are interest-bearing, the amount of accrued interest should be tested for reasonableness. Generally, auditors do not confirm deposits by direct communication with customers unless the amounts involved are substantial or controls are considered to be deficient. Most accrued liabilities expenses represent obligations payable sometime during the succeeding period for services or privileges received before the balance sheet date. Examples include interest payable, accrued property taxes, accrued payrolls and payroll taxes, income taxes payable, and amounts accrued under service guarantees. Accrued liabilities represent accounting estimates made by the client of amounts that will subsequently become payable. In evaluating the reasonableness of accounting estimates, auditors use one or more of the following three basic approaches. Review and test management's process of developing the estimate, review subsequent events or transactions bearing on the estimate, independently develop an estimate of the amount to compare to management's estimate. For most accrued liabilities, the audit approach will emphasize a review and test of management's process of developing the estimates. Estimates may be particularly susceptible to misstatement, especially in circumstances in which management is under pressure to show increased earnings. The basic auditing steps for accrued liabilities include examining any contracts or other documents on hand that provide the basis for the accrual. The auditor will appraise the accuracy of the detailed accounting records maintained for this category of liability. Next, the auditor will identify and evaluate the reasonableness of the assumptions that underlie the computation of the liability and test the computations made by the client in setting up the accrual. The auditor will determine that accrued liabilities have been treated consistently at the beginning and end of the period. Consideration for the need for accrual of other liabilities not presently considered will be given, and then for the significant estimates. The auditor will perform a retrospective analysis of the prior year's estimates for evidence of management bias. Auditors should verify that property tax bills have been received on all taxable property or that an estimated tax has been accrued. Accrued gross salaries and wages verification procedures consist principally of comparing the amounts accrued to the actual payroll of the subsequent period. The auditor should determine that the client's accrued pension liability and post-employment benefits other than pensions are presented in accordance with FASB ASC 715. Accrued vacation pay begins with a review of the permanent file copy of employment contracts or agreements stipulating vacation terms. Next, the auditor will check the computation of the accrual for arithmetical accuracy and agreement with the terms of the company's vacation policy. The cost of rendering warranty expenses should be accrued as expenses in the year the product is sold rather than later when the replacement is made or repair service is performed. The essential step in auditing commissions and bonuses is to reference the authority for them and then verify the computations. Income taxes payable will generally equal the computed federal, state, and foreign taxes on the current year's income tax returns, less any payments thereon. Auditor's inquiry of officers and review of corporate minutes may uncover professional services received for which no liability has been reflected in the accounts. The audit working papers should include at a minimum lead schedules for accounts payable and a trial balance of the various types of accounts payable, including accrued expenses such as interest, taxes, rent, and wages, as well as current liabilities arising from deferred federal income taxes resulting from tax allocations, deferred credits to revenue for such items as rent or interest collected in advance, and deposits on contracts and similar advances from customers. The confirmation process, if used for accounts payable, should be documented, and a listing of unrecorded accounts payable, as previously illustrated, found during the audit, should be presented. The nature and amount of trade accounts payable may change greatly within a few weeks' time. Consequently, the auditor's verification of these rapidly changing liabilities is most effective when performed immediately after the balance sheet date. Audit work on accounts payable performed before the balance sheet date is of little value if the client fails to record important liabilities coming to existence during the remaining weeks of the year under audit. For this reason, most auditors believe that most of the audit work on accounts payable should be performed after the balance sheet date. Some current liability accounts other than accounts payable are more suitable for preliminary audit work. The documents relating to accrued property taxes may be available in advance of the balance sheet date, and amounts withheld from employees' pay also can be reviewed before the end of the year. The working papers relating to such liability accounts then may be completed very quickly after the end of the accounting period.